Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of AleaGreen, and thank you for joining us today to the webinar with the topic Prospect for the Energy Markets in Europe in the Coming Winter, Renewable Energy Projects Financing, PPA versus Merchant. Our first speaker today will be Oriol Salto, Data Analysis and Modeling Director of AleaSoft and Associate Partner of AleaGreen, that will analyze the evolution of the European energy markets. Then, we are sharing this webinar with Jaime Vázquez, Director of PPA and Finance of Soto Solar, that will talk about the renewable energy projects financing. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentations. And now, I hope you enjoyed the webinar. Oriol, please share your slides.
Thank you. Thank you, Alejandro. Good morning, everybody. So let's see, we will see how the energy markets are evolving. How are they right now compared to the situation in our last webinar? It was 5 weeks ago. You can say that the energy market situation is relatively quiet and calm. We will see that there have been not much movement in prices, but there's a lot of political discussions going on right now that may or may not affect energy markets and their prices in the future. So let's start right away because we have lots of things to show. As always, I will start with some brief explanations of what is AleaSoft and the services that we are offering. In AleaSoft, we offer forecasting services for the for the energy markets, covering all the energy markets in Europe, and now also starting to covering markets in North America and South America. And well, our goal is to cover all the energy markets globally. So in 2023, probably we will be starting to look at the Asian markets. We forecast basically any variable, anything that can be interesting for the energy market. So obviously brand, price and demand for the energy markets, but also all kind of related variables like renewable energy production, weather conditions, socioeconomic indexes, fuel prices, CO2 prices. And we do not only forecast spot markets, but also for the electricity markets, ancillary services, intraday markets, imbalance markets, and also covering all the horizons. So for forecasting for the short term, mid-term, that's usually up to 3-5 years ahead, and going up to 30 years ahead with our long-term forecasting reports covering all the European energy markets, and also where we provide hourly granularity for the price forecasting, as we will see, very interesting and very useful for asset valuation, capture prices calculations, etc. The methodology that we use for forecasting is our own methodology. We developed it to forecasting specifically the variables in the energy sector. It's a hybrid technology. It's completely scientifically based. It combines more classical statistical techniques like regression, time series analysis, very important, with more advanced technologies and techniques like artificial intelligence, machine learning algorithms, recurrent neural networks, etc. This scientific based methodology gives consistent results that keep coherency from one delivery from the next one. Very important when you are trying to keep the valuation of the assets in your balance stable. And well, we have been using this methodology for more than 23 years now. We're starting in the Iberian electricity markets and now covering all the energy markets in Europe. As always, I like to start with this historical perspective of the Brent oil prices. oil price is kind of a global an index of how the global economy is going, at least until now, when it's based on fossil fuels. So basically, recently recently we have reached the highest prices that we had since 2008, but right now prices have been down, and they are already now below $100 per barrel. If we zoom out in the last month and last weeks, after reaching one of the highest prices in history by the beginning of the summer, we have seen this downward trend in prices, basically because the supply was strong, was solid, and then there have been some concerns about how the global demand is going to evolve now that we are seeing how COVID is kind of getting traction again in China, and how the consequences could be. So also how European and how European markets are trying to get independent from Russian oil. But again, Russian oil deliveries are getting stronger. They are already close to the levels that they were just before the start of the war. So basically, also the OPEC countries have cut production, so prices have been stabilizing, and right now they are, as I mentioned, below $100 per barrel. What can we expect in the near future? Well, starting on December, G7 countries and also the European Union are trying to establish a cap on prices from Russian oil, but it's very unclear how this price cap will be set. They started saying it would be around $30-40 per barrel. Now they are already talking about $65-70 per barrel. These prices are, well, compared to the production cost for Russia for extracting the oil, these prices are already above that cost. And also Russia is already selling oil to some countries below that price. So if that's finally the price cap that is set, probably we will not see major impacts on market prices, but we will see. Theoretically, the price cap starts operating in December 5, if I'm not mistaken. So we will see, but right now it's difficult to say that it will have a huge impact on market prices. So some uncertainty, but clearly nothing major is expected in this sense. Gas prices. So after reaching the highest prices in history in just by the end of August, as reserve and stocks, reserved gas have been reaching the highest levels sooner than expected, even in the European Union. Basically, prices started going down as the mild temperatures. The winter was a little late in the European countries, so basically a lot of reserves, demand is still low. Basically, prices were going down, so down that they even reached the levels that we have in June 21. So in June 21 we were starting to feel that prices were going up. So we even reached that level. But since then, cold temperatures are arriving in Europe. So the balance in the stocks, withdrawals of gas are already higher than injections. So reserve level are starting to go down, and so prices have been in an increasing trend in recent weeks. CO2 prices, on the other hand, since the war, have been well, not really stable, but without a clear trend. So we have seen since the recovery from the COVID crisis, a clear upward trend. But then at the beginning of the war, everything, let's say, this market received a huge shock, and then prices have been with some important volatility, but basically without a clear trend, some level shifts, but basically in the last weeks, the volatility it's been it's even been lower than before. This market it has an important have some speculative components. So basically, until the situation it's uncertain and unclear, basically prices are going to be more or less in this region, as I mentioned, lower volatility and maybe some level shift, but still no clear trend in the near future. About the electricity markets, as always, I will not have time to go market by market, but at this point, I always like to share you some of the information that you can find in the Alea Energy database. It's an online platform where you can analyze, you can look, and you have all the data more or less related with the energy market. So everything in one place with one format, and you can even make some kind of analysis. So basically you have information of most of the important energy and electricity markets in Europe. We are adding new data and new markets every day. Also fuel prices, also future markets. And today I like to show you for the Spanish market how in recent days it's something that's very so it's something that's normal in the Spanish electricity market, but something that's been very clear in the last days is how the wind energy production impacts on the market prices. So in blue you have daily market prices. In red the average daily the average production wind energy production each day, and you can already see how this clear anti-correlation. So when the wind energy increases, market prices decrease. If we can look at since the beginning of the month, you can even see it clearer. So we had at the beginning of the month an important period with very low wind energy, and at that time market prices were clearly higher than we had afterwards when the wind energy production start increasing. Also, we are approaching winter. Wind energy production is usually it's higher. So we are seeing right now, as in Spain, we have a cap on gas price. We basically have no dependence right now on gas prices. So basically, most of the behavior that we are seeing in the short term in the electricity prices are basically based on wind production. More things, for instance, in the futures market. Let me do something that we will see afterwards, but here I can show you what has been the evolution of Cal24 for Spain and France since the beginning of the year. Basically, Cal24 in Spain, in Cal24 we will not have the price cap. Price cap will end in mid 2023 if it goes as expected. Basically, since our last webinar that was here more or less mid October, we have seen how Cal24 for France it's been really stable, much above the Cal24 for Spain, because in France they have now this component of how the nuclear energy and nuclear power plants are going to deliver in the following month and the following year. So higher prices for Cal24. But in Spain, since our last webinar, Cal-24 prices have been increasing. Right now, they are not. They are already stabilized around this 150 euros megawatt hour, but there's been an important change. The price has increased, but the volume traded in the futures market has not been so much. If I'm not mistaken, there's been, I've counted around 5-6 transactions in all these years, but there's been an important change in the price. It's important to notice how illiquid are these markets and how we can have this price shifted quite rapidly, quite sudden. So going back to to my slides, here they are. Okay, so also in our website you can find all the reports that we have and all the analysis and reports that we have for the energy sectors and the energy markets. As I mentioned, long-term reports we have covering all European markets, but these are the ones that are most demanded. Also analysis on anything that can impact electricity prices, long-term reports about green hydrogen, interconnections, anything that can impact the markets at the long term. Also analysis and for individual projects, so captured prices, optimization of individual power plants, and also some reports about PPAs, PPA market, PPA conditions, how are the current prices, current conditions for PPA in Spain and in the rest of the electricity market. What I will show you is this summary. This is the average price for some of the most important electricity markets in Spain, and basically, so the last complete month that we have is October. Since the September, that is the month that we saw in our last webinar, prices have been down by half, so 52% decrease on the average market price. Spain that has in place its price cap for the gas used in electricity generation. Prices were already lower, so the decrease have been much lower. So basically, following the decrease in gas prices, all the electricity market prices have been going down. Looking at more specifically in the last days, these are the daily average prices since September. Basically, by the end of September, we had the peak, the historical highs in gas prices that reflected on very high electricity market prices. Since then, gas prices have been going down, also electricity markets. And Spain is here below with the price cap in place. So basically very stable around the 40 euros megawatt hour of gas that it has its price cap. And as the MIB gas price, that is the reference price that is using the Iberian electricity market, have reached the reference price or the cap that is set right now at 40 euros megawatt. Basically, we have been that. So basically, the rest of the markets and the after compensation, that a posteriori compensation that the consumers in Spain have to pay to gas plants have been basically set to zero. So everything very, very concentrated in these very, very low prices. In the last days, as gas prices are going up again, most of the markets are increasing prices. Spain is still in the clearly below, as the gas price cap is still in place. So now let's take a look at the futures market, the forward curve. What are they saying? We are comparing the forward curves of yesterday of Tuesday. Compared to the one that we saw in our last webinar. It was 5 weeks ago. In the futures prices for the Brent oil, basically, as we have seen, spot prices for Brent have been quite stable, basically no changes, some volatility around the same price. So as the spot prices have not changed, expectations in the future haven't changed, basically no changes in the forward curve. In the gas price, in the gas forward curve, on the other hand, we have seen something that we haven't seen for some time right now, that it's a decrease in the whole forward curve, in the whole horizon. So we were seeing lately we were seeing changes basically on 2023 futures. In the last webinar, we saw how a huge decrease in 2023, but basically no change on the forward curve from 2024 on. But now what we are seeing is a decrease on the whole curve. So this is something that we haven't seen for a while. Basically, 13% decrease on 2023, and on average in the whole horizon, decrease of 17%. But the decrease in euros per megawatt is more or less, as you can see, more or less the same. But as 2023 prices are higher, so the decrease is higher. And in the whole horizon, an average, as I said, of 17%. In the CO2 forward curve, also we have seen spot prices have been relatively stable since our last webinar. The forward curve has increased a little bit, but something interesting is that the forward curve is getting flatter. So if you remember during, but let's see the next graph that it's in this graph you can see the spread between the futures for December 28 and December 2022. So basically we are seeing the difference between December 2028, so the difference between this price and the difference between this price. Okay, so this is saying us how steep is this curve. No? The higher this spread, the steeper is the curve. So the more rapidly is increasing. So for quite a long time in our webinars, we were saying, look, webinar after webinar, so basically month after month, the forward curve of the CO2 prices were getting steeper. So we were seeing how futures, the prices in the far end of the horizon were rising or were decreasing less rapidly than the prices in the near future. So basically, curves were getting steeper, and then already in our in the last 2 or 3 webinars, we have seen how it has stabilized, let's say. So the slope in the forward curve has been really stable. And in the last weeks, our last webinar was mid-October, so it was more or less here. And in the last weeks or last days, basically, we have seen how this spread has decreased. So the curve got a little flatter, so less slope and a smaller slope. So this is, as you can see, this is a change of behavior. We changed from a rapidly increasing steep of the slope of the curve, stabilization, and right now, at least, we cannot yet say that it's a clear trend, but at least we have seen a change in the slope. Let's see how it will change in the future. And about the power curve for electricity markets, so basically no changes at the long term. As always, I like to remember that these are very liquid markets, so basically you cannot trade energy beyond 2024, maybe something now. Basically, beyond 2024, it's not. You will not find a buyer or a seller for the energy that you need, at least on large enough amounts. So basically no changes at the long term. And in the short term, we are basically seeing spot prices for Cal 23 next year basically are following the spot prices. So basically no changes in Spain. And in Spain, we have very stable price due to the price cap, and a decrease in the futures for the rest of the countries. And then in 2024, that was what we have seen before in the AleaSoft energy database, how futures for Spain has for Cal 24 has been increased recently around 50%, so it's quite a lot. So we have seen this increase, even having very few transactions. Also some increase in France for Cal 23, but basically no changes in the rest of the markets. And as I am arriving by the end, as always, some elements that we are going to take into account when forecasting, also as a summary of everything that we have said. So as we have seen, no much changes in the prices, relatively quiet situation for the last weeks. But as I mentioned, there's a lot of political discussions of what will happen even in the next month. And we have price caps everywhere. So there's a proposal of the European Commission to cap the revenues or to cap the price that the inframarginal technologies are receiving. So basically nuclear and renewable energy. Right now, the proposal is to set it around 180 megawatt hours. Previously, it was 150. Anyway, it's still not clear. And in Spain, we have already a cap on what it's called the minorization of the revenues of these energies, and it's set much lower. It's set at 67 euros megawatt hour. So the idea was to apply this minorization to the rest of the European market, but still, it will if it gets through, it will be something very different. Also, caps on oil price. G7 and European Union are trying to set this price cap on the oil, on the Russian oil. Right now, as I said, the idea is to put it around $65–70 per barrel. But if this is the final price, impact on markets is expected to be low or negligible, because as I said, Russia, this is below the production cost of Russia, and Russia has been increasing their oil extraction and production. So basically, even with lower prices, they are still getting important revenues. Also, it's not mentioned here, but also we have a proposal of the European Commission for a cap on gas prices, a cap on TTF prices, but that's really unclear how it will go, because right, the last proposal, it's at 275 euros megawatt hour. That's a very huge cap, because a very high cap, because prices, even in the worst periods of this crisis, prices were close to that level. But so it's there is a lot of controversy, because most of the countries doesn't really see how this cap can make any improvement on market prices for the consumer. So basically, it's still in hot discussion. So we will see. Also, in the Iberian market, we have the Iberian exception in place. The gas reference price, so the price cap, it's right now at 40 euros megawatt hour of gas, but this cap will start increasing in December. 5 euros megawatt hour per month until May next year, when it will reach 75, I think. So we have been seeing a very stable price in the Iberian market because of this cap, but now this cap will start increasing. So probably, unless gas prices really start decreasing, we will start to see how prices in the Iberian market will start increasing. Also, the colder temperatures are arriving in Europe, so we see how gas demand is increasing, also how this is impacting gas prices, and gas prices are starting to impact in the electricity market prices. And again, at the longer term, so we are talking 2040, 2050, Basically, things are getting more or less as always. No much impact on this recent events. Basically, at the longer term, we are seeing an equilibrium with the cost of renewable energy production, cost of green hydrogen, the cost of energy storage. Basically, equilibrium prices that are more or less at levels that levels that are quite similar to the ones that we had before this crisis and before the COVID crisis, that was the previous crisis. And let me finish inviting you to our next webinar. It will be on December 15. And we will be seeing how the markets have been evolving. Very interesting to see how all these price caps are already in place. We will see how are they affecting. And we will be talking about the future. We will be talking about 2050, the energy markets, green hydrogen, energy storage, how all this can create business opportunities, how all this will be impacting on energy prices. So we will be talking a lot about the future and about how this European energy system is going to be in 2040 and in 2050. Thank you, Alejandro.
Thank you very much, Uriol. Great presentation as usual. Jamie, Jaime, when you're ready, please, you can change your slides now.
Okay, thank you very much to AleaSoft for organizing this webinar, and welcome everybody. I'm going to have to present on renewable energy projects financing, PPA versus merchant, and give a bit of an overview of PPA structures, pricing, etc. So if I can, Oriol, if you can stop sharing, please, the screen so that I can share.
You can share already. Yeah.
Okay. Sorry. Great. Okay. So is it okay? You can see it now?
Yes.
Okay. Perfect. So first, give you a quick intro on Soto Solar. We have, well, basically it was founded by the founders of STEC, which it has now renamed as Return, and Sunrock. Sunrock has installed more than 1 gigawatt rooftop PV in Netherlands. We have funding for more than 100 million euros for development and construction of PV plants in Spain. We basically have 3 business lines. First one is recently renamed to EKI to highlight this part of the business, which is focused on commercial and industrial self-consumption. We run a business model where we are responsible for the construction and the development and construction and operation of the PV plant, and we basically just have a PPA with the self-consumer where they buy, they pay for the electricity that they consume from our PV plant. Then there's the Soto Solar, which is a typical large-scale developer and IPP. We have both greenfield projects and brownfield projects where we basically buy in the market at different stages. And here the typical project size is between 5 to maybe 150 megawatts in size. And then there is a different line which is very specific, which is the Erasmus project. It is the largest project in Spain and in Europe that we are developing. It's 1,000 megawatts nominal, and there's a short video I will show you now to introduce it.
The largest photovoltaic plant in Spain. Located in Sateruela, it has secured more than 2,000 hectares. (1,000 megawatts of photovoltaic power will be installed with battery storage system and production of green hydrogen. with an annual production of over 2 million megawatt hours per year, equivalent to the energy consumed in 200,000 homes. We will invest more than 660 million euros. We will create more than 2,500 jobs during the construction of the plant and 50 during the 40 years of operation. Determined to protect and develop biodiversity. Innovation-driven. In collaboration with the National Hydrogen Center and Enegas. The largest photovoltaic plant in Spain.
You're on mute, Jaime.
Sorry, yes, sorry. So that's the basic introduction to what we do at Soto Solar. Now, we're going to now move on to a section which is to have an overview of the PPA structures. And well, basically, I'll go quickly on this section because I don't want to go into deep details. So basically, there are on-site and off-site PPAs. Basically, the off-site is if it's not connected directly to the internal network, and on-site is when it's behind the meter. The on-site has to be physical. The off-site can be physical or virtual. We'll see in a moment what that means. And then there's different profiles when it regards to the volume, to the amount of energy in each hour of the day. So let's see this in this detail in the next slides. First, when it comes to a physical PPA, that means that that's a direct agreement between the generator who is selling the electricity to the buyer, who is the off-taker. So that's a direct agreement with physical delivery. Legally, there's a transfer of the ownership of the energy under the PPA. And it's basically a supply agreement where there's a supply of energy and a price set for that energy, which is paid directly from the off-taker to the generator for the volume under the PPA. So that's kind of the most simple structure, which is quite used, especially when the buyer is connected to the electricity system, to the same electricity system as the generator is. Then there's a virtual PPA where it's a little bit more complicated, but the advantage is, of course, that it provides some flexibility. Basically, here the generator sells the electricity into the market, and the buyer, if it's a consumer, they purchase electricity from the buyer, and then there is a settlement which happens afterwards, by which there is a liquidation of this contract compared to the strike price, which is the PPA price. So basically, if the market price was higher than the strike price, then the generator has received more money from the market. They pay this difference to the buyer. So the end net result is that the generator receives market price minus what they pay to the buyer. So at the end of the day, they keep the strike price, and vice versa for the buyer. Basically, the buyer pays the market price in the market, but then they receive some money back from the generator, and the end net result is they remain and they have purchased the electricity at the net price of the PPA price, which is called usually a strike. Now, this structure provides more flexibility. For example, it could be transnational, it could be performed by the buyer, could be not a consumer, but even a trader. So it has some flexibility advantages. But probably the most the greatest sort of problem with this potential problem is because it's a financial derivative, it needs to be reported as such, and then also the auditors will have a look whether this derivative is effective, if it's effectively hedging the purchase or sell price for the different parties. If so, they would consider it as they would allow to use hedge accounting. If not, they would enforce a speculative accounting, which means basically this PPA could affect the PNL as the valuation of the PPA changes from year to year. So and that could be a problem if that happens. Regarding pricings, I mean, there are many different structures. The most used ones are the first and second, which is either fixed price or floating price. Fixed price means that the price can be is set up in advance and independent of what the market price is. So you can have it can have a fixed price which is flat, which is complete. The price is constant over time. You can also have it can be escalated with a fixed escalator every year, or it can be linked to the CPI in the respective country, or it could be it could have also negative indexation. This is this can be useful in environments, especially like now, where the market price is decreasing over time, because basically it means that the PPA price will be higher in the first years and then will be decreasing over time, which is good for the generator and for the financing of the project because you receive more revenue in the first years. It also aligns better with the market tendency of the prices. Then the other structure, which is most common, is a floating price that is basically a discount over from market prices. That discount can be in absolute terms, like 6-10 euros, a fixed amount, or it could be a percentage, like it could be 5%, 10%, whatever. And usually that, in exchange of that discount, the generator wants to have a floor, which makes the project bankable, because at least there's a guaranteed minimum revenue that the project will be receiving. It could also be instead of a floor, a collar, where there's not only floor, but also a cap, a maximum amount that would be payable for the electricity. Then there's also other structures, but are not so common in the market. There's just collar with no discount, reverse collar, hybrid. Well, hybrid is common because basically it's basically could be comparing the percentage of output under the PPA and under market. Usually PPAs in the free market are close for about 70% of volume, and could be also hybrid, could be over time, could be, for example, starting with a fixed price and then changing to a collar, and obviously once the PPA is over, then you have a full merchant structure. And clawback, which is very rare, and I don't think it's usually bankable because there's no minimum guaranteed revenue that the project receives. Okay, moving on to the volume of energy under the PPA. Here, the key idea is the electricity is a very specific or a very special commodity, because the price of this commodity changes from 1 hour to another. So it's very important to fix what is under the volume for each hour of every day, because that obviously makes a huge impact on what the economic value of this PPA is. So there are different structures. First one is a base load, where basically there's a fixed amount of electricity for each hour of the day. This usually aligns fairly well with the consumption profile, but probably for a producer bears quite a bit of risk, especially if it's a solar generator, then it's probably not I mean, it bears the risk of what the price would be during the night hours when they are not producing. Then there's a sort of the other extreme, which is pay as produced, where basically the PPA is agreed for a percentage of the volume of the actual production. That means that the generator has no risk, because basically whatever is produced, they sell a percentage. If the production is zero during night hours, or because there's an outage at any given point, then obviously the energy and the PPA is zero. Obviously here the risk is on the other side. The off-taker has the problem of not knowing exactly in advance how much energy they will be receiving under the PPA for each specific hours. So a middle ground, which is usually good for a solar PPA, is the solar profile, where in advance there's a shape predetermined for the amount of energy that will be delivered for each hour of the day, and that aligns with the expected production. So basically, the buyer has certainty on what volume they would be receiving each hour, and the producer, yes, they could have deviations, but most likely the production would be looking like the shape they have committed to, and if there are deviations, they have to bear that risk, but it should be a manageable risk. This slide is just basically to show that there are the different types of PPAs can be sort of complementary. For a consumer, it probably makes sense if it's possible to start with an on-site PPA, where basically they have advantages of for self-consumption. There's no distribution lines here. It's connected directly to the antenna network. Then it could be, for example, complemented with an off-site PPA with a plant, PV plant, which is elsewhere in producing electricity and being delivered through the transmission and distribution networks. And then you could have a PPA with a wind farm or another generator, batteries, etc., to complement and to reach the base load consumption that they have. Finally, on this section, basically this is just a very approximate numbers. Obviously, they're not. It's basically just considering that usually for retailer and for offsite PPAs, usually their regulated costs are around 30% of the total invoice. Probably now that the price have increased, that could be a bit lower, but usually they tend to be 20 to 14, but now closer to 20. For an on-site consumption, obviously there's no regulated cost; it's just a direct connection. So this is showing what has been the market price evolution over the years. So really, before the 2020 up to 2020, it was relatively low. Then obviously increased quite a bit, and including the wheeling charges. This is basically the charges that are for distribution transmission network and the system costs. This would be the total price that the consumer would be paying for the electricity supply over the years, and that compared with the self-consumption, which is exactly what in the self-consumption example is just the PPA price. There's no market price. There's no wheeling charges. That's why I was saying that probably makes sense to start looking at that if it's possible, because obviously depending on that requires having a space available near, in the vicinity of the consumption center. So then we pass on to the third section, which is comparing, now that we've seen briefly the PPA structures, merchant versus PPA. And here in merchant, obviously, we need to look at market prices. Obviously, Oriol has given us a great presentation on that. Here I just have a quick summary. And there's clearly two different phases I would differentiate. Before summer 2021, when we lived in a more or less stable world, at least regarding the electricity market, prices were ranging 40 to 60 euros more or less. Here in the graph, it's showing the prediction of AleaSoft in the high and low cases, and the black line is the actual prices. In this scenario, PPAs in Spain started to being closed by 2017, more or less, with high 40s, and then decreasing prices over time to maybe even reaching low 30s by the end of this period. As you can see, when you put that on the graph together with the actual market prices, you could see there was obviously a difference. The PPA price tends to be lower than the actual market prices, but not that lower. It's as I'm putting there, the PPA discount was commensurate to the risk mitigation, because obviously that means you have an assured price for your energy over 10 years, peace of mind for the shareholders, and gets easier financing. Even at some point in time, the market price even was obviously far lower. We remember that scenario than the PPA prices. So that was more or less the scenario that we had. What happened after the 2022 pandemic? Prices became incredibly high. I mean, we all remember not long ago the market maximum was 180 euros. That's obviously long gone. It was unthinkable when that barrier was removed that we would cross that threshold, but we have repeatedly and very much ended up with that barrier, and not only very high, but also very volatile, at least in the short term. I mean, I think the market consultancy has become much more difficult. So again, I think advisors like AleaSoft have become more and more needed in this scenario. It's true that prices are expected to normalize in the mid or long term, but this process has been delayed for some time, and so prices regarding PPA prices, they have increased, but not as much as the market prices. And it's true that the PPA price now depends very much on the delivery start date, because the prices are not stable. They are changing. So it's not the same. It's not nearly the same a PPA starting delivery in 2023 than 2024. And the graph on the right actually reflects this situation. The blue line is the solar futures that are expected for the next 10 years. Note that here we should probably not be using futures. We should be using market price projections, but obviously I cannot show that. So I'll show public information, which is the futures. The lines also are futures where they have a PPA product, which is basically the average of the futures corresponding for those years. So the green line is a 5-year PPA. The red line is the 10-year PPA, and the orange line is the 5-year PPA, but with 1 year delay, starting in 2024. So and then the bars are the average, so more or less expected PPA prices in the market. So basically, as you can see, if you compare that with the OMIP lines, the red line should compare with the red lines, and the green line should compare with the green lines. You can see that the PPA discount is now large compared to the futures, but as I said, also the futures are not the perfect comparison here. So also regarding on the marginal prices, we have to consider what Oriol also mentioned, which is there's now the government has put in place some mechanisms to limit the market prices, because obviously the government considers that the consumers shouldn't be paying such high prices. So in Spain, there's first of all, there's a clawback on the windfall profits. Basically, the high gas prices, because of the marginalist market that we have, means that all generators, when gas plants are setting the price in the market, then that means that all generators are basically getting a high price. So that means the government has put in place an adjustment, a revenue adjustment that depends on the gas price and the percentage of time when the gas price has set the price or has been within the 10% margin. And this table, there's a formula, but this table basically gives you how much revenue is deducted from the generator, considering what is the gas price and how often or what has been the percentage when the gas price has been setting the price. And as you can see, it can be fairly significant. It's important to look at what plants are excluded, because there are some exclusions. Obviously, if they apply, then this mechanism doesn't apply. It's excluded if the plant is lower than 10 megawatts, if it's in non-peninsular systems, if they are under any auction regime or specific retribution system. Also, if they are under a fixed price, not a market discount, but a fixed price PPA for that volume, which is under fixed price PPA, signed before March 22, or if it's signed thereafter, if the fixed price is lower than 60 euros per megawatt, and any excess over that amount has to be paid back under these mechanisms. I mean, 90% of that has to be paid back. This mechanism, in principle, right now officially is in place until December, but I have no doubt that that it will be extended. In fact, it's been already declared by the government that it will be extended, and it will continue to do so while the gas price remains high. And then also there's a gas price cap, which means that when calculating the electricity generation offers by gas plants, there's a cap on the gas price input. That's just for the electricity generation bid. What happens, of course, the gas plant has to pay the full gas price, so that basically they get compensated for the difference. This cap was initially set at 40 euros and basically lasting for 6 months, and then rising 5 euros each month to reach 70 euros in May 2023, which is when this mechanism is planned to end. And also that's meant to be a soft landing, because by that time, when this mechanism was launched, it was projected that by May 2023, the gas price should have been around 70 euros. So the disappearance of this cap shouldn't be a big impact on the market. Theoretically, for a gas turbine closed combined cycle, in theory, the marginal cost is multiplying the gas price by 2 plus the CO2 price, 40% of that. So that means if we consider a cap at 40 and the CO2 price is at 70, in theory the gas price should be 110. That's the theory. Obviously, that doesn't necessarily is the case. And lastly, there's a limit on the electricity income at the European Union, which is proposed at 180, and that has to be implemented in each member state. And as Oriol was saying, probably because of these two previous mechanisms, it's already implemented in Spain. And then this is my last slide. Basically, with all this in mind, from the generator point of view, obviously the off-taker point of view is the opposite. Is it a good time now to close a PPA, or best to go full merchant? Obviously, it's troubled waters, and you know that means there are opportunities, and the good thing is to have a choice. So here, very clearly, I've put PPA option, full merchant option, pros and cons. For PPA, it's very good that the PPA price has now increased quite a bit, as we have seen. Clearly, if you have a PPA in place, you avoid all market risk, cannibalization risk, solar wind capture price. You have peace of mind for shareholders. Your IAR is strong, is robust. All banks, including major banks, are very interested in providing debt, senior debt, even if it's a large project, with good financing terms, a longer tenor, lower cash sweep, DSCR is lower, higher leverage, resulting all this in a high debt amount, and in theory, at least, a lower interest rate. On the opposite side, it's true that under a PPA option, the project will probably receive lower IAR, even though the financing terms might be better. The IAR is probably be lower, and there's limited market upside. Obviously, if it's a fixed price, no market upside on the on the volume under PPA, and that applies both for energy prices and GDOs if it's a bundle PPA, which includes the renewable energy certificates. On the flip side, the merchant option, you have higher revenues, especially to start with. And if we look at the futures, basically the math is very simple. In the first 4 years, you can get pretty much roughly the same if you believe that the futures prices will be the right ones, will be what will happen. You get the equivalent revenue of the 10 full years PPA. So that obviously that means that you make a lot, you make more money faster. You also have an upside from the GDOs, which are now trading at high prices. So that results in higher expected IRR. And regarding financing, the good news is that they are starting to become available. Major banks, many of them don't still finance fully merchant, but they are starting to consider it. You can get financing from medium or regional banks. Institutional and investment funds are also coming to the game, and crowdfunding platforms. Probably these last two at shorter tenors and higher interest rates, but that's still an option. Obviously, as cons, that means that in this scenario, you are fully exposed to market level variations, capture price, government regulations, as discussed that we have seen. So the IRR is clearly volatile. And if it's a large project, this might not be an option, and probably also for the shareholders, it's not advisable to have all your eggs in the one basket. And especially when the tenor is shorter, you might have a higher risk on refinancing the balloon at the end of that tenor. So overall, my recommendation would be to have a balanced strategy as usual. If you have a portfolio of projects, you can choose to have a balanced approach, have PPA in some of them, have fully merchant in some of them, possibly smaller ones. Overall, you would be trying to capture the pros and avoiding the cons in these scenarios. And sorry, I'm just 2 minutes over time, but hoping that was useful.
Thank you, Jaime. I don't know if Alejandro is already connected. I see him, but okay. Okay, Alejandro.
Yeah. Thank you very much, Jaime. Very interesting presentation, and thank you again for sharing this webinar with us. We will start now the Q&A section of the webinar, and since we are already out of time, we will answer only a couple of questions. Uriol, I see you have already selected the question.
Okay, let me see which one I'm going to answer. Well, just a quick answer. Yes, the reduction mechanism that Jaime was talking is already extended, as he mentioned that it would probably be. It is already extension until the end of 2023. And another question. Now I don't find it. Okay, another question about something that I said about providing hourly granularity for the price forecasting up to 30 years. It's are hourly forecast over 30 years horizon necessary to value a renewable asset? Yes, they are. They are very useful and they are necessary in some terms. Basically, when you are trying to value or trying to understand how much revenue you will get from a project, it's important to consider not just the average market price, but the capture price of your project. So basically, understanding and knowing the profile production or estimating the profile production, that is something that we can also do of your project, and applying hour by hour for the hour by hour price for the next 30 years, you can get a clear image of what will be the revenue coming from that project, and then estimating its value.
Thank you, Uriol. And Jaime, I see that you have a question to answer.
Yes, the question is, since hedging costs are increasing and there's an important lack of liquidity, do you see utilities interest for PPAs decreasing? Is this having an impact on PPAs, lower fixed price, less competition? Well, I mean, utilities interest in PPAs, utilities as buyer of electricity, no, I think they are very interested in PPAs, because basically, when you are buying on a PPA, you are buying at a discount price over the market. So obviously that's a very interesting option. What is happening is there's and the lack of liquidity that's affecting the futures market. Not what is happening is not a lower fixed price. It's the opposite. There's a lack of projects being available for PPA or to go merchant, where they have to have that decision because of difficulties in permitting and delays and difficulties in connection, especially in the last 2 years. So that in fact means that the PPA prices have been increasing also in line, as I was saying, market prices have also increased a lot. So utilities interest as buyer is increasing. Basically the market has changed. It used to be a buyer's market where buyers were dictating the rules. Now it's become a generators market, because there are so few projects that generators that have projects available for PPA are now, they are dictating the rules.
Okay, perfect. And we will answer the remaining questions directly by email. And as Uriol mentioned, I invite you to register to our next webinar in December. And thank you again, Uriol and Jaime, for your presentations, and the audience for joining. Have a nice day.
Thank you. Goodbye.
Thank you very much.